Today, I have the pleasure of speaking to Harris Kupperman, CIO of Praetorian Capital. Harris, great to have you on Forward Guidance.
Hey, thanks for having me on. Appreciate it.
You had a tweet about the pain, a pain trade. Tell us why we are in a pain trade, and specifically the dynamics that a lot of hedge fund managers like you are encountering, where they have these tremendous gains throughout the year, and the dynamics that plays.
So this reminds me a lot of 2018, and a lot of my friends are having just huge years this year. It's been a really good year. A lot of good directional trades. Anyone who's in energy, anyone's in small cap value, guys are just killing it. And in our business, management fee is nice, but everyone shows up to work because they want the incentive allocation. And you get paid based on performance. And guys are looking at the volatility right now. They're looking at what's happening with the headwinds. Nothing's really going right in the global economy. You get headwinds. Jay Powell has told you that he's going to be against you. He's raising rates. You got this Omicron thing floating around. You got lockdowns. You got China's slowing down because Xi doesn't really have a plan. That's hitting commodities. You have all these things kind of going. And guys are looking at their year and they're saying there's 30 days left. Maybe I should just buck it and lock in my gain and go off to the Caribbean and enjoy it. And how can you blame them? It's been such a good year for so many people. And so on days like yesterday where it starts fading a little, that emotion of let's lock it in and come back in January, and it kind of just like picks up again. And in 2 weeks it's gonna get super thin. Everyone's taken off for the holidays. You're not gonna be able to execute really. There's no incremental buyer, so it starts rolling. It starts really rolling because who's going to show up last week of December and say I'm putting new money to work? I mean, no one's around, and so guys have to make a decision the next week or two what they want to do. And I think it's why we saw yesterday on the way down. The move just started accelerating and snowballing because a lot of my friends are saying, okay, I'm up 100, 200% this year. Like, let's just make sure I get paid. Especially because for a lot of people, this is the first really big year they've had. A lot of my friends weren't riding tech frauds for the last 5 years. So this is the first good one. So I understand why these moves to the downside are getting kind of accentuated.
To what degree do you think that quantitative tightening, or actually I should say balance sheet tapering and the prospect of rate hikes, is a true threat to financial markets, or is it only somewhat of a threat because people think it's a threat?
Well, I mean, it's a true threat. Inflation, they say it's 6 or 7. I mean, I don't believe the government numbers. I mean, if things were only up 6, I just bought lunch. It's not up 6 from last year. I can tell you that. I think you have real double-digit inflation right now, and the Fed's 1,000 bips behind. I mean, Fed funds should probably be 500 bips right now. Maybe it's 1,000 even is the right number. And these morons are still printing money. They're so far behind. But the problem, and it's a big problem, is we're in day like 10 of the taper, okay? And, ARC's collapsing, all the frauds are collapsing, the Ponzi sector went no bid. The whole economy, the whole financial system is built on a hoax, and it's built on liquidity. And, they did a week and a half of taper, and it's all falling apart already. And so they're in a bad spot because they really should be taking rates up a few hundred bips from here. And they can't because it'll blow the thing up. At the same time, inflation is going to keep accelerating. Oil's down this week. It's down $20. But I think it's going to just keep going higher. And, the Federal Reserve has nothing to do with the price of oil, but they're going to be constantly forced to react to the price of oil, just like they'll be forced to react to supply chain bottlenecks and also to other things that they have really no control over. The Federal Reserve, they have 2 knobs. They can QE or QT, and then they can go out there and raise or lower rates. And neither of those really are going to do much. They're 2 knobs. It's not going to do much to the price of oil and all the inputs that are driving this inflation. And they're just going to get further and further behind. And eventually, I think they're going to be forced to react, and the equity markets will probably have a heart attack.
Yeah, we're having something of a heart attack, or maybe I should say a few heart palpitations over the past week. A lot of your colleagues are pulling their hair out, worried because for the reasons you said. You, Kuppy, are made of stronger stuff. You're not selling down a lot of positions, or definitely not shorting anything. You're holding firm. Can you tell us about why you're doing that?
Well, I degrossed a few months ago. I mean, part of making money at this game is looking forward a few steps. And, I've taken my exposure down all throughout the year. It was still a little bit over 100% gross, but I've been taking it down all year long. I'm in lower beta stuff. Look, I had a bad week. I'm not going to lie. It kind of sucked. But, I've had a great year. And, I was kind of unched for the month of November, so I'm not really crying. And, it's part of the game. You have to understand, if you're going to have big years, and that's the goal of my fund, you got to accept that there's going to be some volatility. And volatility, you don't know when, you can't really time it, but you accept it's going to happen. And it's just part of the game. And it happened this week. And I don't think it's done. It's probably going to stay volatile.
So you degrossed, you cut some of your positions, but you really have stuck with your allocation to what you call Project Zimbabwe. Zimbabwe historically has had extreme levels of inflation. I don't know to what degree you're being tongue in cheek because we've had 6.2% on the CPI. With Zimbabwe, that level of inflation is like Weimar levels, where you have wheelbarrows full of cash, you have the $1 trillion bills. I take it that you don't think that there will be a $1 trillion U.S. bill anytime soon. But can you just take us? Why do you think you will continue to see extremely high inflation, and why are the assets that you have invested in? Do you think that they will be buoyed by this high inflationary environment?
So we're basically long inflation in my fund. If you look, the Federal Reserve, like I just said, they did a little bit of taper and the whole thing got wobbly. They'll do another round of taper and another, and the whole thing will implode. And that's not good for democracy, because the voters will complain, just like the voters complain about inflation right now. You're kind of trapped in two places. Right now, everyone's yelling at J-Powell about the inflation, and in a few months, they'll be yelling at him about the stock market crash. But the big picture is they're going to keep printing money. They have no choice. They're trapped. And, they can either crash the market or they could, have a crack up to the upside. I think that's what they're going to do. At the fiscal side, they've gone totally insane. They're printing, they're basically handing money out, stimmies and everything. And, this sort of stuff, it takes a while to filter through the economy. And it's now filtering through the economy. They've pushed demand in crazy places. And, it's all just kind of lifting up. Name me an asset that has been up like 50% this year.
Bonds.
Well, bonds are fucked. But, look, it's all going up. And I think that, Project Zimbabwe is a bit tongue-in-cheek, I get it. But I think we'll do Zimbabwe light. And maybe we're not going to do like 1,000% inflation, but why can't we do, 50 or 100? We're already at like teens. And I think there'll be moments of terror along the way where governments kind of realize that they're overstimulating. They pull back a little like we just did right now. And you see fiscal and monetary are both kind of taking a pause right now. And then the market will get wobbly and everyone will panic because you're on a 2-year election cycle and they'll print a bunch more money and spend it again. And so I think, if you're running a portfolio, you want to be maxed out long, you want to be structured in a way that if there's a down 20, it's not going to take you out of the game. And, getting taken out of the game, you don't get a margin call, you don't want to be selling at the bottom, you don't want your LPs redeeming you, you want to stay max long. And so you structure your portfolio in a way that you can remain max long and live through pullbacks. Look at my portfolio. We're an energy fund, basically. The price of oil just dropped $20 in a week. It sucked, but it wasn't that bad, because the way that the portfolio is structured, we're mostly using out-of-the-money calls to express the long view. So the overall, delta on those calls just isn't that high. So when it goes against us, it doesn't kill, and it's just a better way to do it. I'm not getting a margin call. I'm not getting pushed out at the bottom here. I actually have the flexibility to add, and I have been adding. I just think conceptually, the cheapest assets are right tail volatility, and I don't think people own enough of it.
Yeah, you said you're basically an energy fund at this point. A lot of your inflationary thesis, you invested in oil, not oil drillers, not oil leasers, but oil futures. As in WTI, Brent, and the futures curve. So specifically, I think you owned option futures and then options on futures of crude oil in 2023, 24, 2025. So I hear what you're saying about the delta because the fact that oil goes down a little bit or a ton here doesn't mean that it goes down so far out in the future. Can you talk about Number one, well, first tell me why oil and not oil drillers.
Well, so I own some Valeras too, but I don't like owning the producers. I mean, I'm not a geologist, and I don't understand basin economics and full cycle economics. And I mean, the people who think they understand it seem to get it wrong mostly. um, uh, what I've seen is that in these cycles, you don't actually get leverage to the commodity. That's all kind of just something that stock market promoters talk about. If you want leverage, just go buy futures. They're pure leverage, and it's cleaner. And you don't have Biden going out there and canceling a pipeline or canceling your permits, or Colorado canceling your acreage, or there's all these weird esoteric risks you're taking. And I want to be long oil. I don't want to be taking funny risks I don't really understand. I mean, it's just the wrong way to play it for me. And besides, I mean, you have so much upside torque. About 4 months ago, I put on a call spread in the December 23 oil futures. I put on the 90 by 100 call spread. It cost me 60 cents. If oil was above 100 in December of 23, I get paid $10 back. It's a 15 bagger. I mean, how many stocks are going to be a 15 bagger if oil goes to 100? I mean, oil was 85 2 weeks ago. Like, I just don't see a lot of these things being 15 baggers. But here I am, taking a smallish risk. It's 60 cents times a few thousand of these things. But you get paid out 15 times. It's just a better trade. It's a better directional trade. I have inflation on my side. I have the government screwing everything up, which you can count on, which is, I want to be long government stupidity and corruption and incompetence. I just think it's a better trade. And, it's just like I went out there and bought the December 25s, I bought the hundreds. I mean, I own a bunch of strikes. I pretty much own all of them. But, I mean, the hundreds, they cost me $2. If I'm right about Project Zimbabwe, I mean, why can't oil be 500? I mean, why can't, I make 400 on two? I mean, that's a 200 bagger. Like, between money printing and them screwing up the ability to produce oil, I mean, anything's possible. We're looking 4 years out. Like, no one can predict 4 years out. I mean, I could be totally wrong also. Most likely they go in the money, though, which is a question of how much they go in the money. In terms of why I chose oil versus gold or some other product, I just used my inherent skepticism of the government and said that much like they're in the market actively manipulating interest rates right now and manipulating FX rates to keep volatility low, they'll go out there and they'll manipulate the price of gold, which they have. They got caught doing it. They'll go out there and play with pretty much any product. And, they're going to want to keep it kind of range bound because it shows signs of inflation. The thing is that oil is physical settled. They can't play with it. I mean, Biden's already dumped 50 million barrels. It's going to run out eventually. So they can't hold it down indefinitely by selling futures because people ask for delivery. And I just took the feeling that they'll keep stimulating until they break something. And, everyone can say, this inflation. I mean, my mom called me up last week and asked why the price of broccoli went up. Like, people know it's inflation. But, the government has the data, but you can't, and besides, what was the price of broccoli last year? Who knows? I can't. But you can look at a chart of oil and see oil going parabolic and this big piece of everyone's life. I think they break oil. And that's the thing that breaks, that forces them to stop printing. And I think they're going to break oil and they're going to keep pushing until they break it. And since I feel pretty good that in the next 4 years they'll break it, I want to be long the thing they're going to break. And when I say break, I mean they're going to shoot it into outer space.
Yeah. So if you look at the oil curve, the front end sold off violently over the past week. I believe actually some parts of the longer end of the curve, which you own a lot of, actually went up. But I understand, I saw you on Twitter that you actually took a little bit of a nibble on the front end, which went from 85 to 60. Can you tell us about that? And just, to what degree do you put value in the curve? I thought that typically a curve in backwardation is a very bullish sign, whereas in contango is more of a bearish sign.
Yeah, they say it's a bullish sign versus a bearish sign. I've looked at a lot of studies on the oil curve, and it really has very little predictive value, which is kind of funny. I'd say the oil curve is more about producers hedging in a market out a few years that's less liquid, and so they just hold the curve down. And the airlines, the truckers, the natural purchasers of petroleum, they're not out there hedging themselves. So It's just a shape of what people are doing. It has nothing, it's not predictive, is what I'm saying. You know, I was buying the back of the curve because I bought 2025 oil futures at 52 when the front of the curve was over 70. It was like 75 or so 6 months ago. And so I said, I'm buying this thing really cheap. And, you know, there's a $20 backwardation to it, probably $25 backwardation. And, you know, the back of the curve started moving up a few weeks ago, which is good. It got into the low 60s. Now it's in the high 50s. But the front of the curve collapsed. And so I said, I'm fine to have some front of the curve. It's not really what I'm dying to own, but you know, there's still some backwardation, and so but it's liquid. So when it crashed, I bought a bunch of those at about 66. I'm break even-ish now. You know, up a little bit. I averaged down a little, but I assume that as Biden stops dumping and OPEC figures out their plan, and you know, everyone realizes that Omicron's kind of a hoax. I think the front of the curve will back up into the 70s and 80s. And if not, you know, with the backwardation, I'm going to pick up a little bit of roll yield. I'll just roll it down the curve until you have a recovery. I mean, maybe I'm risking $5-10 here to make 20. Or maybe I'll stay with it longer. We'll just see. I mean, I don't want to be all oil futures, so you know, you can't just max it completely. But it looks like a nice little strategic spot to take a stab at it. And so I bought some front of the curve, and I haven't owned any front of the curve at all.
And then what about the U.S. oil fund? That's an ETF that owns futures of the curve. Historically, the USO, the ticker, has done very poorly because a lot of times the curve was in contango and they had all these fees. And of course, USO got absolutely clobbered when oil went negative in 2020. Not a lot of people knew that it could go negative, but now we all know. I understand, what is your thought on USO? I think I saw you say that the vol of USO was quite high. Were you like trying to sell some insurance on both ways of that, or what are your thoughts on that?
So USO, it's a funny product. It owns a bunch of spots on the curve. It picks up a little bit of roll yield right now, which is probably the first time in a long time it's picked up some roll yield. No, vol spiked. It was the highest vol since oil went negative. I mean, it really spiked yesterday. And so I sold some puts. I don't mind owning it. I mean, it's just another way to express my oil view. It's, you know, if oil's at 66, I want to own some more. If it's, you know, 60 or 58, where I'm getting assigned, like, I'll own some more. So it's a way to basically ladder into a trade. And if not, I'll pick up some yield. I like doing this when things overshoot. You know, implied volatility goes up and you get paid too much to sell it. And I sell it. I think they paid me like 15% at the money for like 6 weeks or something. It seemed wrong. And if I have to own more oil, I'm not going to be upset.
Yeah. Kuppy, it's really interesting that so much of your holdings are actually directional, you know, long delta of oil, betting that the price of oil goes up, rather than any specific companies, because your research service you recently launched, KEDM, Kuppy's event-driven monitor, that is extremely specific on all sorts of special transactions and conversions and CEOs being fired and buying back the stock and short interest being high, all sorts of very microeconomic, very fundamental company-specific things that are, you know, completely opposite than macro. Can you tell us what it's like having more of a macro position now? Even though historically you've been an extremely company-specific investor.
So I do both. Okay, I do two things. Actually, I do three things. I do small cap growth value names, but there's nothing that's cheap anymore. I remember 20 years ago, I was buying companies that are growing really fast, and I was paying 5 times earnings, and the earnings were growing 50, 100% a year. It was great. I mean, now, something growing 50% a year, it probably trades at like 20, 30 times revenue. There might not even be any profits. Like, it's just not a world with opportunity in my mind. I've done a lot of what I call inflection investing. This is take a macro view of something, usually something that's been beaten down and very unloved, like energy. And you catch the inflection where it goes from, absolutely hated, and it usually goes full cycle, to loved, and then back to hated all over like a 5-10 year period. And I do that over and over. This is, I don't know, my 5th energy cycle now. It just keeps repeating. I do a lot of this sort of stuff. But I also do a lot of event-driven trading. I have a service, like you mentioned, KEDM. Go to KEDM.com. We have a free trial. I recommend everyone take it. But we're tracking over 20 event-driven strategies. These are mainly corporate events, but also fund flow events, where we're tracking, spin-offs, privatizations, demutualizations, bankruptcy exits, CEO change, like all sorts of things that, because when you look at the world, anything that goes in a linear fashion gets modeled out. And there's a lot of people watching this, and they're just looking at a situation, they're modeling it and trying to guess, what's happening next quarter, next year, whatever it is. But they can do it with a linear progression, and they usually get pretty accurate. The opportunity, I think, is in stuff that's really hard to model, where there's a lot of quarterly volatility or year-to-year volatility, cyclical businesses, and these things get modeled poorly. But particularly they get modeled poorly when there's corporate actions going on. There is no model. The spin-off, they'll give you a pro forma, but there's so many moving pieces, and even the pro formas don't usually work. There's added costs, there's savings, there's so many different things that when you look at the model, the range of outcomes is so wide that you have an opportunity. Plus, you have a lot of, given the way that the market's evolved, a lot of the shares are owned by non-economic owners. An ETF just owns shares. If there's a spinoff, the ETF just sells the shares. They don't look at the value. They don't say this is cheap, let's hold it. They just say it's not part of my basket, buy. And so guys like me take the other side of it, and you have a couple day window where you can create a lot of value if you've built a model and you know what you think it's worth. And sometimes the ETF dumps it to a price that's insane, and sometimes the ETF doesn't. But there's a whole lot of opportunity, and that's where I'm finding opportunity these days, is these sort of situations that aren't linear, that really are corporate events. Let's talk about CEO change. Usually what you see happen is CEO changes and the company goes off in a different direction. Sometimes the new guy's good and it goes in a better direction. Sometimes the new guy sucks and it goes in a worse direction. Going in a different direction that can't be modeled. And usually a new CEO wants to make his mark. He wants to show that he's doing something to earn his stock options. He usually gets stock options the day he joins. So he's very incentivized to do something that makes the stock go up. And, we look at the situations where you have a company that struggled for a long time, and, the board of directors didn't really want to have any tough love there and fix the problem. And eventually it got so shitty that they fired the guy. They brought in a new guy, and the new guy starts fixing things. Usually the first thing he does, though, is blame everything on the old guy, and he sets expectations super low. And that's when we come in. And so you have a situation where a company's been hurting, it's been decaying, and the new guy comes in, and then it goes like that. It just drops off the wall, and everyone says, "Oh, this thing is a lost cause." And everyone just models it as just decaying. And the new guy comes in, and sometimes it gets better. Sometimes it is a lost cause. But these are the sort of situations that create opportunity, and that's why we created a service to track this stuff, mainly because I want the data myself.
Yeah, and I should say about when you're saying a CEO leaving, it's probably not an example like Twitter, where Jack Dorsey recently left. It's a company that most people have never heard of, and therefore it's not going to be priced in, and it will not be economic. Just to give people an example watching this, as an example of how specific and in the weeds your research is, do you want to talk to us about Silvano printer paper?
Yeah, sure. So there's a position we own some. International Paper had an uncoated free sheet business. That's printer paper. It's a business that's slowly disappearing because no one prints anymore, but it's still a massive business globally. And International Paper spun it off because they couldn't sell it to anyone. And it was holding back their overall growth numbers because this business is shrinking. They spun it off. It's an unsexy business. It's not really an attractive business, but they're one of the low-cost players globally in what is a shrinking business. And it collapsed. It started trading in the mid-30s. It dropped all the way to 24. We bought a lot of it at 24. We were paying about 3 times cash flow for this thing. And yeah, it shrinks a few percent a year. But, they're a low-cost guy, and right now there's a shortage of printer paper because a lot of factories converted to corrugated because of everyone's getting Amazon back boxes. And so there's kind of a shortage of printer paper globally. These guys are making good money. We track cluster insider buys. That's another, strategy. If insiders like something, we usually like it. We had a cluster buy. Multiple insiders stepped up and bought stock. Here we are at 31. I paid 24 8 weeks ago. It's a nice quick return. I think it's probably going into the 40s. But I wouldn't have known about this. It's a small-ish company. I wouldn't have known about this thing if we weren't tracking it at KEDM. And then I put it on my screen, and it kept dropping every day because everyone, International Paper is mostly owned by index funds. I don't know anyone who wakes up in the morning and says, let's put some of this in my IRA, you know? So the index funds had this thing they weren't allowed to own. And there's no one who wakes up in the morning and says, I need to buy some uncoated free sheet for my IRA. So there's no bid, you know? It's very different. You mentioned Jack Dorsey at Twitter. I think that's worth looking at. You know, I think it's universally agreed that, you know, Jack is a visionary, but he's also a little bit insane. He's had 2 companies. He tried to move off to Africa. I don't think he's ran Twitter very well. The monetization's always been a disaster. I mean, it's a decade on and they still don't have an edit button. Like, this is low-hanging fruit that I think they could use for the user experience. And I don't know. I mean, I'm not a tech guy, but I feel like I could run this thing better. Is the new guy the right guy to fix the problem? I don't really know. I think an outsider, the stock would be at 70 instead of 42 right now. But I know the new guy is going to try to put his mark on what's happening. He's going to try to have some early victories and show the world how smart he is. And he's definitely going to set the company on a different direction because I think it was kind of universally agreed it was going in the wrong direction. I mean, that's how they got activists in the first place. So, you know, it's a situation where there's going to be a change of direction. It's going to be difficult to model. We don't really know what this new guy's plan is. He hasn't really, you know, told anyone yet. It's worth watching. I mean, it's a great business with a 30 billion EV. I mean, if they could just unfuck it slightly, it's going to be 100 billion EV. So, you know, it's worth watching, and we'll see where it goes. But these are the sort of situations that create opportunity, in my view.
Yeah, so that's EV, enterprise value, which is equity value plus the debt. But in my head, when I heard that, I also thought electric vehicle. We've seen a lot of emissions, let's say, from new IPOs and SPAC reverse mergers of companies that have electric vehicle companies, and they're very good at making promises, very good at marketing, but not so good at making cars or making money. Can you tell us your outlook on the sector, and then also, if someone would have your view, they might be inclined to short them. But tell us why you're hesitant to do that.
Well, I don't short in Project Zimbabwe. The market only goes up; it just goes up at different speeds, and there'll be very short, sharp declines. And some people are really good at timing that. I don't think I am. So it's just really hard to short. It's painful. I've tried it a few times over the last year and regretted it immediately. It's awful. So I don't think people should be shorting these things. At the same time, like Rivian, they haven't produced any trucks yet. It's worth $100 billion. It makes no sense. Tesla, I mean, it makes no sense. But I mean, Tesla made no sense, and then it 20-baggered. That's why they short this stuff. So look, there's a lot of things that go in the too hard pile when I'm investing. I try to go into situations where I have massive edge. If I could buy uncoated free sheet at 3 times cash flow, and I know that they're going to delever for a bit and then give me a fat dividend or a buyback or something else, that's a layup. Guessing the right price of Tesla, I mean, I tried that. I sucked at it. It's not for me. I know it's not for me. And I'm going to stay out of stuff that I'm not very good at and focus on the stuff that I'm good at.
So let's talk about something where you think you do have a massive edge, and that is uranium. You had an interview with my old colleague and friend at Real Vision in the summer, or maybe it was late spring, where he asked you about uranium. CCJ was just probably peeking his head out of the 20s or wherever, and you were like, that uranium thing. Uranium, it's better to buy uranium at 50 than 30. People have been telling me that story for 10 years. I'll believe when I see it. However, now it's completely different. You are foaming at the mouth bullish on uranium. What's changed? What's your outlook? Tell us, share with us your view.
So I've been hearing this uranium story for years and years. It went nowhere. I kind of got coaxed into it in the fall of 19. I tossed it all in 20 early on because the world kind of crashed and I wanted capital. Look, uranium is a commodity. The marginal cost to produce the stuff is in the 70s, let's call it. It's consistently traded in the 20s and 30s for the better part of the decade. It's been just a terrible place because there's too much of it, and it was oversupplied, and there was no catalyst. It was cheap, but these mines kept producing it at a loss, and eventually they went bankrupt. That's what happens when you produce it at a loss. They shut the mines, and in a commodity industry, it's a very long cycle to heal. And so now we're in a situation where the world produced about 125 million pounds, about 25 million pounds of secondary resource. So let's call it 150. These are very round numbers. The world needs about 180, going on 185 next year. So let's say there's about 35 million deficit. And so we're using up the above ground stockpiles. And this has been going on now for 3 years, a similar deficit. We've used up about 100 million pounds. What really changed in my mind is that this entity called Sprott came out there and it started issuing shares to purchase uranium. And they've already bought over 20 million pounds. So it's almost like a full year worth of global consumption. It all happened in about 3 months. And so the day Uranium Sprott Physical Trust started issuing shares, I kind of watched it. I was curious. And by about day 3, I said, okay, this thing is actually going to absorb a lot of uranium. And I bought a lot of it when uranium was around 32. Now I went from a couple, maybe 50, 100 bips of uranium. I owned a little bit of Sprott before. I went to position max, which is 35% of my fund in about 3 days. I bought Sprott, I bought Kazatomprom, they're the world's largest producer. I bought a little bit of Cameco, even though it's a turd. I bought a couple of the little, the smaller juniors. I don't want to name them because I'm not proud I own them, but they've gone up a lot. But mostly I just bought Sprott, and I bought a lot of Kazatomprom. And it's done very well for me. They've absorbed 20 million pounds. I don't know when or how. I just know that if you go out there and you keep buying physical and the world keeps consuming about 3 million pounds a month, eventually you're going to run out of uranium and the price will go up from half the marginal cost of production. I bought it in the low 30s. It'll go to the marginal cost of production, and then it's going to go past the marginal cost of production because if you want to restart some of these mines and get back to an equilibrium where the world's producing 185 million pounds, you need a profit motive. You need the price to go well past, let's call it 70, so that a bank will fund you and give you the capital you need to turn your mine back on. I mean, there's plenty of deposits in this world. There's plenty of mines that are shuttered that can be brought back online, but you need a profit motive and you need some stability of price for a long period of time so that people finally go ahead and do it. Which is why commodities often overshoot to the upside and the downside. They rarely spend a lot of time in the middle. They're usually way too high, in which case a ton of supply comes, or way too low. And I've made a career out of just playing the cycle in different commodities. This is my second uranium cycle. And kind of have a clue of how this is going to go because I was in the last cycle and it was very good to me. I think one thing is worth looking at is there was an entity called Grayscale Bitcoin Trust. And last year I noticed that it was chomping away at Bitcoins. And I saw that the rate was buying them started accelerating. And I saw a point on the chart that I thought I was risking a couple $100 to see what would happen. And at 9,200, I bought a lot of Grayscale, a lot. And it kind of exploded higher to 12,000. It pulled back to 98. All my friends sold. It stayed between 10,000 and 12,000 for about 4 months, and it just kept chomp. And then one day they ran out of Bitcoins that people wanted to sell at 12,000, and it basically went from 12 to 60 in like 3 months. And it was really good to me. I had a lot of it. And I think it's very much the same with what's happening with Sprott. It's chomping away at this, and eventually you're going to run out of supply. But unlike Bitcoin, no one actually needs Bitcoin. It's just no one needs it. And I know you guys might disagree, but that's my view. But if you have a power plant, you really need uranium. Without uranium, you have a paperweight. It's like GameStop. It went straight up. It was a short squeeze. But eventually, people sold because they had profits. They sold it. Then it went down. With uranium, if the price goes to 500 or 1,000 and a power plant still needs it, they still need it. And someone's going to have to pay for that. It's going to be, the government or ratepayers or, someone's going to have to pay for it. But without uranium, you don't have a power plant. And so I have a feeling that once the price starts moving, it's going to be very explosive because a lot of these utilities are going to chase each other and chase after the pounds because there's going to be a shortage. It's kind of inevitable, If you have 30 million more demand than supply, eventually it's going to fix itself. And so I really like this trade. It's my biggest position. I tend to run a very concentrated buck. I look at these sort of idiosyncratic trades. I don't have to care too much what the stock market's doing. It's a better way, I think, to invest. If the stock market goes up, I don't know if uranium goes up. If the stock market goes down, I don't know if uranium goes down. It just does its own funny thing. So I tend to like sectors like that, and I own a lot of uranium. And so far, it's been good to me.
Can you just walk us through China? What's your outlook there? We're seeing a lot of reverberations in the credit market. A lot of debt is being called in. And yet we haven't seen the Chinese yuan revalue as many macro investors had anticipated. Why do you think that is? And are you looking to buy some dips? Alibaba is now more than cut in half from its all-time highs.
Oh, I wouldn't touch that shit. I think it's got a zero. No, look, I'm no China expert, okay? Xi is obviously out there trying to do something. I don't know what his plan is. I don't think anyone knows what his plan is. It could just be he has no plan. But he's kind of taken a hatchet to a lot of the national champion companies. He's sacked CEOs. He's killed some CEOs. It's kind of crazy what's going on there. It's kind of a shitty time to be a billionaire in China. And I don't really know what the plan is. Evergrande is the first controlled detonation of a company, and all of this is kind of hurting their economy. Obviously, there's credit ramifications, which is what people are looking at right now and looking at the banking system. But what's happening with the renminbi is that corporates in China are over-levered, and they're starting to sell off international assets and repatriate the money and pay down their debts. I mean, we saw the same thing in Japan. The Japanese went on this crazy buying spree, and they were buying hotels all over the place and trophy assets. And then over 20 years, they started selling down those assets to pay down debts. And as you repatriate those funds, it puts a bid under your currency. And that's what we're seeing with the renminbi. And that bid obviously is hurting the economy there. And then globally, it's exporting deflation. And so eventually, China could either go the route of Japan and watch the yen appreciated for 20-something years until Abe stepped in and said, no, this is dumb. I don't know why they took that pain for 20 years, but they did. The Chinese could take the pain, or they could be pragmatic and try to find a middle route. Or they could just one day show up and devalue. And given the way Xi's been acting lately, he's probably going to do something totally out of left field. But no, I mean, until then, it's putting a bid under their currency, and it's exporting deflation globally. And it's just interesting to watch. I mean, I'm not putting $1 of my money in there because it's lawless. I mean, I want to go to places that have rules.
Even though, if you put a chart of Alibaba with the revenue, the net income, and the growth over the past 10 years, it would look very similar to like a Google, a Facebook. And yet even then, you still think it's a bagel.
Well, no, I mean, I think the numbers at Google are correct. I think the numbers at Alibaba are fake. Like, they're just make-believe. I think there's no possible way that those numbers are real. I mean, the question is how fake the numbers are, and there's some disagreement. But I feel pretty confident that those numbers are fake.
Mm-hmm. All right, let's talk about another stock that's been cut even more than Alibaba, which is Robinhood. This dropped on the scene a few months ago, and we can put a chart of it, what an ugly birth into the stock market world it has had. What's your outlook on the company, your long-term outlook on the company? And then I understand you're doing something a little bit idiosyncratic, which the opportunity to do it may have already passed.
Well, so Robinhood, look, I think it's probably not worth what it's trading at. It's at $24 right now as we're speaking. It's probably worth like a couple dollars. It might be worth $0. I think payment for order flow will eventually go away. There's too many regulators looking at it. And, Robinhood's also done too many dumb things to their customers over the last couple of years. And I assume there'll be fines and penalties and new regulations put in place. But at the same time, it's a company. To me, I would never invest in this thing, but there are idiosyncratic fund flow situations that are interesting because over a big data set, there's opportunities. And so one of the things we track at KEDM is unlocks. And an unlock, just for people who don't know, when you IPO a company, or in the case of Robinhood, they direct listed it, a certain number of shares start trading on day one. And then over certain periods of time, there's what you call an unlock, where restricted shares are allowed to be traded. And there's a lot of early investors in Robinhood, there's a lot of employees, and I think they'd rather turn their shares into something that's real. And so they're going to sell their shares and then go buy toys or some better investments. And so you have a situation where there's an unlock. It's well telegraphed. You have to read the proxy. It's there. I mean, no one reads it because it's a 500-page document that's kind of boring. We have someone that reads it for us. We keep track of this. And so in the case of Robinhood, almost 500 million shares came free trading. They started free trading yesterday. And it was pretty obvious that was going to put a lot of pressure on the stock. And the stock's down from the mid-30s to it opened yesterday at 25. And if you look at this, if you short these things about 30 days before the unlock, especially the ones that are below the IPO price, especially the ones where the number of shares unlocking as a percentage of the float is disproportionately high, like with Robinhood, is pretty good money to be made. And in this case, the stock dropped almost a third in those 30 days, which, it's textbook, alpha. It's just pure money in a way. What was also surprising is that these things tend to get hedged out. I mean, it's illegal to do swaps, but everyone's kind of doing it. And so when you get to the unlock day, they usually stop going down. And I don't know why that is. It just is. And so yesterday, with implied volatility well over 100, I wrote some puts. It's not a huge position, but I wrote some puts because the odds say it stops going down. And at 100 vols or 120 vols, if it goes down, I can roll the puts. And it's hard to really lose much money, especially given what I got paid. As long as there's no event risk and there's no earnings, I mean, they're past earnings. So, I mean, you have a trade, first you short it, and then you write some puts after the unlock. And this is why I built KEDM, so I keep track of this. And we're doing this across, lots of securities. But, I thought it was funny. I threw that out on Twitter because I thought people would laugh, and they mostly did, because anyone who knows me knows what I think of Robinhood. And so the fact that I'm taking a long biased view, I mean, they thought it was funny. I thought it was funny. But I'm up on the trade already. It's good.
Kuppy, I feel like as soon as I get familiar with your sense of your style of investing, you're like, oh no, I'm doing something completely different. And I think that's because you really are very proficient in these three styles of investing that you have. What advice would you give to someone who's newer in the investment world? Can you learn all three at the same time, or do you have to master one before you move on to the other ones?
Well, I don't think I changed that much. I mean, in the end, investing is you buy something for less than it's worth and you sell it when it goes to what it's worth. It's not rocket science. I mean, it's more about how to find those opportunities, and that goes in cycles. Okay, you could have moments in time where growth is great. You have moments in time where the opportunities are in depressed commodities, like last year where I was buying oil and gas stocks. You can find opportunities in all sorts of different places. I mean, the hard thing is knowing where to go fishing. You fish where the fish are. But just knowing where to go looking, and also knowing when to just hold on to a bunch of cash and do nothing, because it's not a good time to be putting the money to work. I mean, as we talked about earlier, the next couple of months, JPOW's against you. G is kind of against you. Commodities are slowing down because China's slowing down. Fiscal's against you because the Democrats are all having a civil war rather than passing anything. Like, you have all these things against you. The seasonals are against you in that it's going to be winter, and COVID is a seasonal disease. It's a flu. So you have all these things kind of against the markets. Probably not a good time to buy. At some point in a few months, everyone will be freaking out, and that's when you want to buy it again. And it's good to sit on cash and wait and be patient. And I think that's the hardest thing to learn, is when just to be patient. Because you're paid to allocate capital into stuff, and it's really hard to sit there and do nothing. That's like the best lesson. Whether it's because you have a trade and it's working. I've seen so many people who have a winning trade and they overtrade it. Look, I got into Bitcoin the same time a bunch of my friends did. I got in at 9,200. I sold mine at 58K. I didn't trade it once. I just wrote it. I have friends, I made myself, 50,000 points. I have friends who picked 5,000 points out of it, or they buy it, they sell it, they buy a dip and they missed it, they link it back on. Like, it's just a dumb way to trade. I mean, put it on and ride it if you believe in it. And I see people overtrade. I also see people in stuff they shouldn't be in because they're bored. I think that's the hardest thing, and that's where I've grown the most, I think.
What are those things? What are those things where you see people they're in things that they just shouldn't be in, either because you think it's a bad investment or it requires such focus and attention that you don't think that a lot of investors have?
Well, no, I think there's a lot of people right now in horribly overvalued stocks because they've gone up for 5 years or 10 years. And eventually they stop going up. And, it boggles the mind. There's people in companies that have no revenue that are in the tens of billions. And, these things may never have revenue, much less profits. Like, I don't understand what a lot of these people own. And yet, it's a super liquid security where they can cash out at a moment's notice. And yet they still own it. It's got greater fool theory, and that goes for a while, and then it doesn't. And I just see a lot of people doing things that don't make any sense to me. I mean, maybe it makes sense to them. I don't know. But I see people making unforced errors all over the place on the screen, and I try to avoid that. Doesn't mean I'm not making mistakes everywhere, but I try to grow. But in terms of your first question, how to find a stock that's going to go up 5 times. I mean, that's easy. If you look under enough rocks, you'll find plenty of them. The question is when to buy them, how to own them, how to size them, when to get out, what are the risks. Like, that's the stuff that's harder. Finding 5 baggers is easy. I mean, we've talked about a bunch of them already on this show, and some won't work. But the key when you're looking for 5 baggers is that you're going to get some wrong, and you don't want to lose any money either. And that's the other thing that's taken me a long time to learn is how to find something with a lot of upside where when you get it wrong, you get your money back. Because, when you run a concentrated book like I do, you're not allowed a lot of mistakes. A down 50 means you need to double your money to get your money back. And, when you have 5 names, you can get 1 wrong in a year, but, you have 2 down 50s and your year's going to suck. And so, the key is when you get it wrong, you may lose 10% or something. It's okay. And that's been the harder thing to figure out. I used to go further out on the risk curve. And now I try not to go out on the risk curve. Let's go all the way back to uranium. I own Sprott physical uranium because when uranium was oversupplied by 30, 40 million pounds a year, the price of uranium was 25. Now that uranium has a deficit, I bought mine at 30. I felt like I was risking about $5. And, compared to where it was trading when the news was terrible and the market was terrible, so I'm taking a small little risk. I mean, uranium it'll be around next year and the year after versus, some little 50-cent stock. I mean, maybe it can go to $10, but maybe they'll do a dilutive offering at a nickel and, you lose the whole company, or maybe you miss a permit, or maybe whatever country it's in has a revolution or a flood, or, there's so many things that go wrong with these things. Like, that's why I could go for more torque, but there's plenty of torque in Sprott, so why go for the torque? And I think that's the hardest thing for me to learn is, you don't have to go full throttle all the time. Sometimes going in first gear is just fine, because if I'm right about uranium, it'd still be a 10-bagger.
And do you expect it to be a 10-bagger? If you look at the price of uranium over the past 20 years, what was it, 2006 to 2008? It just had a huge run that was incredible. Like, it was a straight line up. It was so fast and such a vicious increase. Are you expecting the same sort of extreme rise, or do you think it could be more muted?
I think this one will be more extreme than last time. I mean, last time uranium was oversupplied. The entire way up, there was actually a surplus. The issue was that there had been some force majeure situations, and some utilities panicked and they paid any price just because they wanted to secure supply. At a time where a bunch of hedge funds and broker dealers, like, look, when Lehman went bankrupt, it owned uranium. There was a bunch of random people out there that shouldn't have owned uranium that were buying uranium. And so those guys all front ran the utilities and panicked the utilities. Here, the same thing is going to happen again. You're going to see a bunch of hedge funds buying uranium. You're going to see Sprott buying uranium. But now there's a deficit. And, if you do the math on this, and I've done the math on this, you get to 2030, and you take how many pounds you expect to be produced in the next 8 years. You take how many pounds you expect to be consumed, because you know how many power plants are getting built. And there's a little bit of variability. Some power plants are supposed to get decommissioned, maybe they'll get extended, and maybe some power plants will miss their deadlines to building a power plant. They're 2 years behind schedule, whatever. But in the very big picture, you're looking at about a 500 million pound deficit of uranium. Now that deficit will get fixed because some mines will have to get turned on. It's inevitable. So you're not going to have a 500 million deficit because nuclear is like 10% of the world's electricity. You're not going to have these big power plants going dark. But these mines, from the day you decide to start it up, it takes 2-3 years to start it up. There's still going to be a deficit. It's inevitable. If Sprott's out there buying 20 million pounds a quarter, that deficit expands. Every time Sprott buys 1 million pounds, you go from 500 to 501, 502. You could massively miss. If a mine has an accident and it's offline for 6 months, you're going to miss. So you have this variability in the model, but I think you're going to have a really big problem. And every pound that comes off the market, every day that goes on where the price isn't 100, so that it incentivizes mines to restart, you're going to basically have this 500, and let's just say that's the number, get closer to getting crystallized in a way. If uranium's 100 tomorrow and they restarted McArthur River, maybe the number is 400 or 300, the deficit. So I just think it's going to overshoot dramatically. It's just math. It's more a question of when than if. And I think one of the problems, and you see this in Sprott, it trades around, it's volatile, it trades on most recent news, or there's so many people that are trying to look at what's happening in the price of uranium and saying, why did this happen? Why did that happen? Oh, let's go sell some, let's go buy some. And it's like me with the grayscale. I just sit there and it's inevitable, so let's just let it happen. And if it takes 2 years, then it takes 2 years. I've been in it 3 months. I'm not, it's not burning a hole in my portfolio yet.
Mm-hmm. Kuppy, do you view BITO, the Bitcoin ETF that was just launched in the U.S., as a grayscale Bitcoin trust moment where it's a conduit between institutional investors who want to invest who previously could not do so? And if you don't view it like that, why not?
That's the one that owns futures?
Yes.
I just think there's enough ways for institutional investors to invest right now that if someone wants exposure to Bitcoin, they're going to get exposure to Bitcoin. When I was buying Grayscale last year, there was no other way. I run a hedge fund. I have a brokerage account. I have no other flexibility. I own some futures also. But there's no real viable way. Now I think there's enough conduits. It's sort of the same. Anything that takes coins off the market is going to increase the price, and anything that adds coins to the market will decrease the price. It's just supply demand. But I just don't think it's going to be as meaningful. And I have no position in anything Bitcoin. I'm kind of out. I sold 58 and I have zero regrets. It's been the same price for 6 months. I'll probably come back to it at some point in my life, but it just seems like kind of dead money to me for a while.
So, Kuppy, at Praetorian Capital, your hedge fund, you target, I believe, trailing 3-year returns, which means that you can take a 20% hit in a month, and investors understand as long as you focus on the long-term performance. You're also the CEO of Mongolian Growth Corp, a company that has a lot of holdings. And that company is publicly traded. So do you put your more sort of safer stocks in Mongolian Growth Corp and put the more riskier positions in Praetorian, or do you sort of you view both of them and you share positions between them both?
So they're two different things. Okay, my hedge fund it's a hedge fund for wealthy, sophisticated investors, and we're going to do things that hedge funds are supposed to do. It's going to be volatile. It's meant to be volatile. It's meant to be risky in a way. And I think people going into it expect that sort of volatility because hopefully there's offsetting upside. Mongolian Growth Group is an entity I launched in 2011. And it was designed to invest in Mongolian real estate. At the time, Mongolia was the fastest growing economy in the world. It's since been a 10-year economic crisis, mostly self-inflicted by the government there. And we've, over time, decided to pivot the business. We're going to keep our core Mongolia exposure, our team. Hopefully, Mongolia one day recovers. But we've been selling off non-core assets and reinvesting. The thing I know best is public securities. We've done a lot of investing in public securities. But there's certain regulatory and tax reasons why we can't go beyond a certain threshold in public securities. And we're really looking to treat MGG, and the ticker symbol is YAK in Canada, YAK, or MNGGF in the US. We're really looking to treat this like a merchant bank. And merchant banks mean a lot of things to a lot of people. But for us, it means buying control stakes in various public and private businesses, helping them access capital, which is something, obviously we have a lot of experience with. And, hopefully adding value to these businesses through our connections and through, our own experience as investors. And, we see a way to kind of bridge sort of a gap. A hedge fund can't do privates. Well, I guess it can, but mine doesn't. A hedge fund's not there to take control positions because you have liquidity constraints. Investors want their money back, and you can't own, 50% of a company. You'll never get out. Whereas with a permanent capital vehicle, we can. And so we're looking to take MGG in a very different direction and use my investing skills. And, I have a team of people who I tend to think are pretty smart. And we intend to hopefully create some value. We're also going to look to launch some businesses internally. And KEDM, which we talked about earlier, is owned by MGG. And it's a nice revenue stream, even though it's only a 5-month-old business in terms of monetization. But it produces enough revenue to keep the lights on and give us the resources we need to keep pushing forward. For people who are interested in MGG, if you look at our Q3 MD&A, it really does show the changes that have been made over the last few years to the business. And you should read my shareholder letter. I kind of detail my plan and where I'm looking to go with this. And I should say that I eat my own cooking. I own a quarter of this company, and I put almost $5 million of my own dollars into it. So I really do want it to work. It's been a pretty sad, depressing experience for a decade. And, for the first time in a very long time, things are looking up. And that's why we're starting to talk about it a bit. And, like I said, I own about a quarter of it. Our CFO, she owns almost 5% of it. The board owns a bunch. Like, we're here working for ourselves. And, you guys can come along for the ride if you want.
Yeah. So, Kuppy, what you're going to say is that what you're saying is it's not going to be a Moderna-like share sale chart.
No, I've never sold a share. You can look at what they're buying. Actually, you probably should. I bought millions of shares in the open market, as did my CFO. There were many months when we were the only ones buying between us and the buyback. And we bought back over 20% of the shares outstanding from the peak. Between myself, Jen, and the buyback, we were basically most of the trading volume for years at a time when it really did look like we'd go bankrupt. But no, we soldiered on. We figured out how to create liquidity. And for the first time in a very long time, we're actually in a really strong financial position. And we're in a position that we can actually kind of pivot the business and hopefully start to do really smart things as opposed to, just move money around to make payroll, which is what we were doing for a very long time. And it was a really terrible experience.
Yeah, well, I will say, Kuppy, I've read KEDM, and I have to say it is a wealth of information. So anyone who's watching this who wants to do that sort of a very event-driven research where this company that no one's ever heard of is spinning off another company that no one's ever heard of, and potentially there are lucrative opportunities, that I cannot think of a better research than Kuppy's event-driven monitor. So, and I'm.
But there's also, look, we have a free trial, so you'd be a moron not to at least take a look at it. It's not for everyone; it's for sophisticated investors. But look, I've made millions of dollars out of the stuff that's flagged for me that I would totally have missed otherwise. So like our tagline is "One idea should pay for your subscription." I mean, I have like multiple lifetime subscriptions I would have been created just in the last 5 months since we launched it. So no, it's doing exactly what it's meant to do, and I'm really proud of it. I'm proud of the guys that work there that produce it.
I bet. Yeah. Before I knew that you had a team, I thought it was just you. I'm just like, what is this guy? He must not sleep, because I mean it's very extensive. I must report on hundreds, if not thousands, of companies.
Yeah. No, it's really detailed, full of knowledge. I mean, I don't think there's any way that anyone can stay on top of all these situations. I know I can't. But we try our best to flag the more interesting ones. And like I said, we're kind of scratching the surface here still in terms of all the event-driven opportunities. But it's really changed my own investing just because I'm not missing stuff anymore. It's really great.
Well, Kuppy, it's been fantastic getting to interview you. You've been someone who's been on my wish list, my interview wish list for a long time. Thank you so much for joining us, and thank you everyone for watching.
Hey, thanks for having me on. Really do appreciate it.